let's get stuck into it. Always lots to talk about with these two. We kick it off with the stock of the day. Thought we'd take a look at Westpac today with its earnings out. Shares have fallen in the morning's trade, down 5% to $24.40 after its cash profit missed expectations. Westpac declaring a $3.5 billion off-market share buyback as annual cash earnings doubled to $5.35 billion, though slight miss on the market estimates. EPS also more than doubling to $1.46. Bank declaring a final dividend of 60 cents compared with its 31-cent dividend from a year prior. Peter King, the chief executive, said cash earnings rose, balance sheet remains strong. He's pleased with the progress that they're making to transform Westpac into a simpler, stronger bank. He says the bank's Australian mortgage portfolio rose 3% or almost 15 billion. Owner-occupier lending jumped 9% on rising market liquidity. Total customer deposits 4% higher to $25 billion. Why you would put your money into a bank savings account is beyond belief at the moment. Gaurav, what do you think of the result?
Look, bank results, they really don't matter very much. These four companies, they are entrenched in their positions. They share the same sort of opportunities, the same sort of risks. There are small differences between them, but it's really CBA is different to the other three, and maybe NAB is worse than the others. ANZ and Westpac, there's not too much to separate them. And I don't remember a time in my career where I've been more disinterested in the banking sector than now. And it's quite odd when I say that out loud, because the capital position of the banks has never been stronger. They have, as you just saw, sort of 12% T1 capital. I remember a time when 8% was considered super strong, and they're now sort of 50% above that. So that's good to see, and I think that tells you that these are very safe institutions, and that dividend will probably be ticking over. The sort of blow-up risk that the banks have faced over the last 20 years is probably not there anymore. But with the strength in that capital position, I think comes fragility in the competitive position, because technology has made rivals more numerous and more powerful than ever before. And you can see that with the actions of the banks themselves. The banks have basically stopped lending to small businesses, and they have passed on the buck to these new generation of fintechs, which we've spoken about on the show before, and those have become the bank's distribution channel. And I think that's very sensible. But it does point the way to where the banks are heading. I think they're heading towards a future where they remain very important to the financial system, and they remain fair businesses, but growth is going to be very limited. These are businesses more about stability than growth, and I think if you're an investor, you'll know with your own portfolio and situation whether these are right for you. If you're interested in growth, this is not the place to find it, but they do pay a nice dividend, and they will likely continue paying a nice dividend.
Okay. So do you buy them just for the dividend?
Look, if you're paying zero taxes and you can collect, and you're one of these outrageous individuals
that get a refund.
They get a refund. First of all, don't get me started on that.
No, I'm with you on that.
Yeah, outrageous. But if you're one of these individuals, this makes a lot of sense. I still think it makes a lot of sense. But anyone else, I don't see a reason to even hold the banks. This is a sell for most individuals, unless you're in that special kind of bracket, and then you can hold or buy it.
Yeah, Mathan.
Oh, it's a roaring sell. I think
a roaring sell. Wow.
Gaurav covered it. I mean, there's only you got to think of Macquarie as a bank as well.
Yep, it's coming up.
It's a private equity. But if you're looking at the four big banks in Macquarie, CBA and Macquarie, if you looked at it over the last 20 years, they're the only two actually trade up over time with improving model, where the other three banks literally trade in a trading range. They just go up and down, up and down. If you exclude the dividends, that's all they do for 20 years. That just tells you they've had, we are sitting on a global property bubble. They have one asset that they play in. It's in a global property bubble. If you're not doing well now, please, when are you going to do well? And when you miss earnings in this cycle, when you've got a RBA and a government handing out stuff to help your sector, please, and you had a Royal Commission, nothing happened. Can it get any easier? That's the question. And the reality is it's an economic cycle play. So the economic growth is going to be weaker going into the next decade because we've done forward bringing of growth. Banks will have lower growth. So Gaurav's right. It's a dividend play. If you want that kind of return and you have the tax benefit to play with that, that makes sense. If you're picking a top 10, 20 stocks,
50.
Yeah, okay, 100. It won't be in the top
You know
100.
what I mean.
It's
Okay.
expensive.
Yeah.
All right. Okay, and that applies for all of the big four.
Yes.
Right. Okay.